Okay, I'll now talk about the financial innovation, and it's a part of measuring and managing risk in innovative financial instrument. It's a part of the emerging challenges or the current issues section. So the whole idea of risk management is to identify and optimize different kinds of risk, and here we are going to look at different type of risks that are associated for new innovations. Now the ability to price an innovation is affected by data, the ability to calibrate parameter, the complexity. Designing attractive characteristic of financial innovation increases both supply side and demand side of the innovation. The level of liquidity for these new instruments is affected by ability to increase supply, demand, ease of pricing, ability to hedge, and transparency of pricing. Counterparty risk, accounting system, senior management ignorance, and operation cost are example of additional concern raised by new innovation. So pricing innovation. Describe the top-up and bottom-down approaches in respective issues. Every technology that we move in, and I remembered when I was studying some books on nano manufacturing, nanotechnology, or any technology, there are two ways to do. In economics, there are two ways to do top up and bottom down. So there are two ways here as well. And the way in which we price a collateral debt obligation or a CDO is quite controversial, and there are various issues that people raise. A major challenge here is that the amount of data is limited, and it's not easy to calibrate necessary parameters required in pricing and risk management. And if you use a very simple model, then we need to estimate, we can estimate things, but they won't be accurate, but we can do that with need to estimate parameter and limited availability of data. So bottom up requires estimation of all cash flow associated with individual assets in the pool of CDO. The first step is using the bottom up is to describe the process of event of default and loss given default for each asset. Assuming assumption regarding the default dependence between the asset and the pool must be modeled. This is difficult to model how default of one asset impacts default of other in the collateral pool. Two approaches are dependency default dependency models and copulas. So if you remember, copulas were used to model how trenches would default one after the another in a CDO. We talked about this in the copula. So creditworthiness of other obligation will most likely be impacted by default of an obligator. If the obligator is in the pool or competitors of default obligators, then the event of default may benefit cash flows of other obligators. Alternatively, if remaining obligator are suppliers to default obligator, then this may result in negative effect. The lack of data make calibration of these type of model difficult, which leads to inaccurate. Now again, the CDOs, the data is not good enough, the instruments are new, you really don't know any default scenarios and how to test them. This was one reason in 2007 we were in a bit of trouble because of the copulas which actually misfired. Moving to the next method, which is the top-down method, which directly model cash flows from entire collateral pool without considering individual trades. The major advantage here is that number of parameters is reduced, and this method assumes different events that causes a loss to occur. The size of loss is dependent on the type of event. The Poisson process is used to model the timing of this. Now if you don't understand, and if there is a question in the exam that why the Poisson process is used to model arrival of events, so Poisson was used in if you remember, we used the Poisson distribution in a random drift or Poisson drift. So Poisson process is used for these kind of disturbances. For example, top down may assume three types of event that could lead to a loss defined by individual obligator, sector default, or economic default. At minimum 6 parameter will be estimated, and consisting of 3 jump sizes and 3 volatilities. Wherever you see Poisson, they'll use jump method, so they'll calculate those disturbance which are like Poisson were distributed in a Poisson distribution. This is quite important. When we are modeling the prices in a stock market, the way one would do is the geometric Brownian motion, or we have drift plus Poisson jump. So if you remember those cases, here also we in the top down method we talk about jump. So I'm just trying to relate this with different methods. Now we need to understand design characteristic of instruments and their effect on supply and demand. The design characteristic of instrument are very important because they impact both the supply side and the demand side. So the design for instrument should reduce the cost of hedging to increase supply side interest. For example, matching maturities of CDS index and IM international money market data makes hedging more effective and reduce the cost of hedging. The biggest challenge for designing new instrument is to identify features in design that will favorably affect the risk and the ability to hedge. So that was it. Now subprime CDO sensitivity to US housing market. The recent financial crisis illustrated how design of CDO tranches made the CDOs extremely sensitive to housing market. Mortgage-backed bonds with double B to double A rating were pooled together to form an underlying assets of a subprime CDO. The subprime mortgage are placed into trust and the aggregated cash flow are separated into tranches. These cash flow mortgage flow and distributed different types of cashes. The lowest tranche is equity and typically subject to overgrowth. The senior tranche is AAA. The design of tranches were prominent. The level of subordination of average BBB bond was typically very small, 3 to 5%. So here the design of tranches was problematic, and the triple B bond, which was the last investment grade bond, the level of subordination was typically very small, between 3 to 5, and the width of the tranche was between 2.5 to 4%. In addition, the thin middle layer prepayment occurred for higher quality mortgages. Therefore, the level of subordination for low tranches increased relatively to upper tranches. The collateral pool was often geographically diversified across the nation to reduce risk. In addition, there was underlying assumption that houses prices would continue to increase nationally on average. This would enable to refinance. Unfortunately, houses prices nationwide and the state fell into recession, compounding the problem. The environment causes loss of correlation to approach one for the underlying. So given the tiny bit of the tranches, if mortgage back defaulted, the rest would follow, wiping out the super senior tranche of the subprime CDO. The design of the collateral pool created a binary situation. Either the cumulative default of subprime remains below the threshold point and the CDO do not incur losses, or the default rate is above the threshold and the super senior tranches of the were potentially all wiped out. So this is how it worked in the last time. So prior to this collapse and the US market, the special investment vehicles linked to hedge fund invested in long-term assets with ABCP, and when the housing prices fell, the special investment vehicle are forced to reduce the amount of ABCP and sell amount during decreasing the collateral value in order to meet claims into asset. Investor did not purchase new ABCP because they fear regarding underlying value of collateral. This scenario generated what is referred to as a wrong way feedback. You remember the wrong way risk, and here it's the wrong way feedback where investors were not buying MBS. So the SIV's liquidity declined, triggering a selling of liquid assets, which increased the downward pressure. All the bond rating previously instead SIV have multiple bag of credit line. The agencies did not anticipate the level of wrong way feedback. So downward pressure on prices could not have been reduced. Do you remember we generally in the emerging issue focus on the liquidity risk, and I am going to come to that in detail in some time. But this wrong way feedback, if people decides that something is going to fail, if liquidity decreases, even no matter how good that thing is and backed by government or whatever, the prices are still going to fall and people are going to face a loss. So it's just an issue of liquidity and not the intrinsic pricing of the instrument, and something like that was happening. So now I move to liquidity of new instrument. And the level of liquidity for new instrument is affected by following factors: the ability to increase supply, demand, ease of pricing, ability to hedge, and transparency of prices. Liquidity improves by building both supply and demand for innovative through education of end user. Liquidity improved for less complex innovation or more easily priced is better. Design innovation with ability to hedge improve liquidity, creating transparency to third party screens that provide bid-ask quotes and market information also improves liquidity. Now ability to increase supply and demand, ease of pricing, ability to hedge, transparency of prices. These are the four issues here in terms of the liquidity issues that comes into play. And after that we have the collateral counterparty risk effect, and we use Monte Carlo simulations to model them. And when counterparty default first, a new contract with the same premium must be priced. For complex instruments such as CDO, multiple simulations are required. Some contracts are so complex that the number of simulations needed are not obtainable to ensure accurate estimation, and counterparty can be mitigated by limiting the total exposure to individual counterparties, limiting exposure to sector, netting contracts, making haircuts in pricing, and posting the collateral and advance payment. So those were it. So I think it's a long one, so I'll again continue back from the liquidity, and then we'll see the counterparty risk into detail, and risk modeling issues that we have, which creates a problem to create those model, like limited data, models ability to hedge, additional consequences, senior management lack of knowledge, operation risk, and sometimes credit rating agencies way of looking at things. So those were it. So I'll continue with this in the second part of this video. Hope you like this one. Thank you for listening.